Thank you to everyone for taking the time to hear about the last 6 months at PensionBee. It has been a fantastic first half at PensionBee, despite everything that we have seen in the external environment. The external environment, I believe, is well known to all on the call. We have had extreme global macroeconomic and geopolitical volatility, and that has undoubtedly impacted every country, every business, and every household in the world. And so against that backdrop, I am very pleased that we have continued to do what is important for our customers, which is to help them prepare for their retirements. We saw an excellent momentum in the growth of our customer base, with the addition of over 41,000 invested customers on a year-to-date basis, representing a growth rate of over 70%, taking our invested customer base to around 160,000 invested customers. This was achieved against a declining cost per invested customer, which we are very pleased about. It demonstrates the scalability of our product and of our customer base, while also demonstrating a strategic and overall reduction in the nature of the cost base used to acquire and serve those customers. During that period of time, in addition to onboarding lots of new customers, we were incredibly pleased with the customer service that we delivered to our existing customers, resulting in an increase in our retention rate to over 97%. And so together, the combination from new customers and from existing customers continuing to save into their PensionBee pensions resulted in our revenue resiliency and the ability for us to be able to reconfirm our profitability objectives, which is to reach the adjusted EBITDA profitability milestone by the end of 2023, and the nearer term metric of adjusted EBITDA profitability by the end of this year. Could I have the next slide, please? Overall, we are very pleased to see that our growth trajectory continued over this period. We continued to generate growth rates in our AUA and growth rates in our annual run rate revenue at around the 80% mark, demonstrating the strong resonance of our product within the UK customer base. Our registered customer figures stood at around the 900,000 mark, and we're looking forward to celebrating the 1 million mark very, very soon. Could I have the next slide, please? Turning to the first half in particular and the performance we witnessed there. The growth in invested customers, as I mentioned, was absolutely exceptional and in line with the growth rates that we have achieved in the past. Even when we were starting from a smaller base, we are now obviously starting from a much bigger base. And so we are pleased to see that growth rate of invested customers continuing. Those invested customers invested into their PensionBee pensions, driving an increase in the AUA of around 35% on a year-on-year basis, and driving an increase in the ARR, so the annual run rate revenue, of over 35% as well. Could I have the next slide? That achievement of growth is very much a resonance to our business model, which continues to be exceptionally well received within the UK market. We focus on our core strategic pillars, the first of which has been, of course, the efficient investment in customer acquisition and brand awareness. We were very pleased to have deployed a majority of our marketing budget in the first half of the year, with a particular focus in the first quarter. And that was really led by our data platform and our data model that demonstrated that customers would be substantially receptive in those early months of the year. We continue to deploy into the second quarter as well, but overall the effect was such that the customer base grew while the cost per invested customer in the second quarter declined. We continue to focus on a slightly younger customer cohort, achieving an average age of around 37 and a half versus an average age of around 39 in the previous half of last year. On the product side, we made further strides. We launched our Easy Bank Transfer functionality within the web estate. Easy Bank Transfer makes it simple for our customers to contribute into their pensions in 60 seconds. And we were pleased to have extended that outside of our app as well. We deployed the Stronger Nudge to Guidance for over 50s looking to withdraw from their pensions, and we continue to work on our regular withdrawal functionality with a launch of that expected in the near term. Could I have the next slide? From a technology perspective, our focus was on efficiency and ensuring that we continue to serve our customers in the most efficient way. You can see that our invested customers per staff member efficiency increased by around 35% versus the past year. And that reflects a lot of internal automation, a lot of simplification around processes, and simply focusing on doing things better as much as we possibly can. We maintained our strong levels of customer service. At PensionBee, we read every review that our customers leave us. And the one that stood out to me the most from the last quarter was a customer noting that PensionBee is a throwback to when customer service in the country mattered and was good. And customer service really matters to us, which is why I was so pleased to read that particular one. We continue to be available to our customers on email, on the phone, on live chat, and any way that they wish to interact. And then finally, we continued our search for an impact-led plan, and we are very pleased that that search has concluded after rigorous customer testing, and we'll be providing more information on the launch very, very soon. I would now like to hand over to Christoph, who will take you through the financial update.
Thank you very much, Romi. Hello and a warm welcome from me to everyone. I'm pleased to cover the financial section of today's presentation. In the first half in 2022 has really demonstrated a strong resilience of our overall AUA. We generated close to £500 million of net inflows over the period. And whilst this would have resulted in an AUA base of more than £3 billion and close to £20 million of ARR for June, as many other companies in the wealth industry, poor markets have reduced AUA by approximately 15% in our case, resulting in a stable asset base for us relative to the end of last year. Next, I would like to highlight the asset growth drivers for the first half of this year in a little bit more detail. First of all, we have driven asset growth through new customer acquisition. Our agile marketing approach enabled us to onboard more than 41,000 new invested customers, and this represented the majority of asset growth over the period at roughly £353 million. The average consolidated pension pot was slightly smaller than usual, and that is owing to market volatility that reduced pension pots around the country, as well as reflecting a younger average new customer. And overall, the average pot size was approximately 17,000 at the end of H1. Secondly, we have driven asset growth through existing customers who have continued to accumulate pensions, the pension saving with us. Growth from existing customers over the period represented £128 million of AUA, and net flows from existing customers together with new customers contributed £481 million of asset growth over the period. We will comment on the quality of lifetime value generation on the back of our strong retention rate and continuous net flows from existing customer base, more specifically on the subsequent page. Lastly, as previously mentioned, we have been impacted by market volatility, As it is customary, pension assets are invested in global capital markets, which have been impacted by a number of macroeconomic factors, including increasing inflation, rising interest rates, and geopolitical tensions. Global market volatility reduced AUA by approximately 15%. In summary, our AUA demonstrated resilience against the backdrop of market decline and exceptional volatility, thanks to strong net flows from new and existing customers. As a long-term business, the lifetime value of our customers is of great importance. Lifetime value is predominantly driven by a high retention rate and recurring and compounding asset growth from existing customers. And we visualized those two metrics on that particular page. First, as you can see on the chart on the left-hand side of the page, we are pleased to report a continuous improvement of our customer retention rate, which is in excess of 97% for 2022. Secondly, on the right-hand side of the slide, we demonstrate cumulative net flows excluding market growth by customer cohorts. What you can see on this particular chart is that all customer cohorts delivered positive net inflows for 2022, even the very early cohorts that have been acquired between 2016 and 2018. This serves as a good reminder of the long duration compounding nature of the underlying business. With an average age in their late 30s, our customers demonstrate a long-term commitment to saving with PensionBee, growing their assets with us every single year. So in summary, generating lifetime value on the recurring and compounding asset growth from existing cohorts is evident in both high customer retention rates and continuous net inflows across all existing cohorts. We have turned our asset growth into a recurring and predictable revenue stream thanks to our resilient contractual gross revenue margin. By way of reminder, the contractual gross revenue margin is the annual fee charged to customers before applying any discount for pension pots over £100,000, which again remained resilient over the first half at 69 basis points. As already communicated, we executed on our plan to accelerate marketing expenditure in the first half, priming us for low-cost marketing growth for the rest of the year. On a trailing 12-month basis, we have seen also an improvement in adjusted EBITDA to negative 152%. Looking at profitability, we reconfirm the guidance around adjusted EBITDA profitability, so being profitable before marketing investment by the end of 2022, and adjusted EBITDA profitability by the end of 2023. To conclude, we have converted asset growth into revenue growth thanks to the resilient contractual gross revenue margin, and we have continued to scale the business operations. The majority of proceeds we raised during the IPO in April 2021 were earmarked for marketing spend, and therefore close monitoring of the spend is critical. We routinely evaluate the attractiveness of marketing expenditure within the unit economics return framework, which includes a cost and return component. On the cost side, we measure cost per invested customer, which represents the unit cost of our marketing investment. And I will cover the cost side on this page, while the return or lifetime value component will be covered on the next. As guided, we accelerated marketing deployment in Q1 this year, which saw a temporary increase in CPIC to £268. And as guided, we brought that CPIC down to below the £260 mark and expect the CPIC to continue to reduce over the course of 2022 for two reasons. First, a reduction in the velocity of marketing expenditure. We expect that marketing deployment over the next quarters to be significantly below the H1 costs, as we expect to have spent 60 to 70% of our total marketing budget in H1. Second, the impact of the upfront marketing investment, meaning the conversion into invested customer, has a longer time period to take effect for the remainder of 2022, thereby reducing CPIC as we approach year end. So in summary, as guided, we expect CPIC to have peaked at the end of the first quarter, and we are now focusing on continuing to reduce the cost of our customer acquisition with more moderate marketing spending levels and an increase in lower cost marketing activities, and to capitalize on our growing brand awareness. It is very important to view the cost of acquisition together with the expected return on that investment in order to evaluate the return potential of the marketing investment, as shown in this illustrative unit economics example. The unit economics framework includes a cost and return component, and the multiple of return over cost guides to the attractiveness of that marketing deployment. With regards to the cost component, as mentioned before, we pay a one-time cost to acquire a given customers to come to our technology platform, which is covered on the previous page. With regards to the return component, once on the platform, a customer builds the pension savings with the company over a long time, evidenced in the high customer retention rate. This translates into recurring and predictable revenue stream over many years. We then pay a fee to our money manager partners, which is variable in nature, and bear the cost to serve customers on our scalable technology platform. The remaining profit accrues to PensionBee and generates lifetime value. The illustrative unit economics of the return over cost calculation with simplified assumption indicates that PensionBee deploys marketing capital with attractive returns of mid to high single-digit multiples. I will now hand back to Romi to cover guidance, investment highlights, and further updates.
Thank you very much, Christoph. I'm very pleased to reconfirm our medium-term financial guidance and objectives. We continue to experience very high levels of revenue growth, with revenue having increased by over 50% on a year-on-year basis. Our margins remain stable, indicating the value for money that we generate for our customers, and we are pleased to continue to see a very, very strong retention rate. As we discuss, our marketing costs continue to reflect our desire to invest in our brand and to acquire customers, while also reflecting the discipline with which we deploy that capital. And so the combined outlook for revenue and costs leaves us well positioned to reconfirm our objectives of EBITDA profitability by the end of next year, and our shorter term objective of EBITDA profitability by the end of this year. Can I have the next slide? In short, PensionBee remains on its journey to make pension simple so that everyone can look forward to a happy retirement. Our market remains as large and as attractive as ever, with around £1 trillion of defined contribution pension assets, of which around 70% is dormant and transferable. Our differentiated value proposition continues to resonate amongst a very large consumer base, and we continue to receive excellent feedback on our ability to help our customers prepare for retirement. Our scalable customer acquisition approach is led by our data, and this quarter in particular, we were pleased to see a decline in cost per invested customer as we drive that cost per invested customer down even further. That enables us to reconfirm our clear path to profitability, and to enable us to generate revenue and to generate growth while also generating on the bottom line. And finally, me and the rest of the leadership team remain exceptionally committed to our customers. We remain committed to helping them save for their retirements. And so we are very pleased with the results that we've achieved over the last half year. And I'd love to see if there are any questions at this point.
Thank you, Romi and Christoph, for that canter through. One here, there's now a huge pool of registered customers, which may be, we hope, converted to invested customers. Can you expand on how these conversions track over time? And if they haven't tracked, for example, in a year, what are the chances of them converting at all?
That is an excellent question. Our registered customer base is a pool of customers who have expressed interest in the PensionBee proposition. They have left at least a name and an email address, and often more information than that. Our registered customer base is a base that we have been building, since the first days of the company, and even to this day, we see customers who registered in 2016, 2017, taking the decision to consolidate their pensions with us and to open a PensionBee account. And so that is a long-term ambition of the company to continue converting those customers, those registered customers, into invested customers. And the way that we do that is by ensuring that we are always offering those customers information, whether that's through email nurturing campaigns or whether that's through more information on our website. It is also by expanding the feature set, which can make our product more relevant to registered customers who may not yet have taken the step to become invested customers. And it is through other shorter term communications, such as push notifications, where a registered customer has come to us through the App Store. And so when you look at the registered customer to invested customer conversion metric, as we do see incremental improvements every year. And the ratio currently stands at around 18%, meaning that of every customer who has left us a name and an email address, they have gone on to 1 in 5 of those roughly has gone on to put in around £20,000 into their PensionBee pensions. And so we think that is a good conversion rate, but we continue to deliver and expect incremental improvements on it through time. I hope that answers your question.
Very thoroughly. Thank you, Romi. Costs per invested customer are currently running at about £250, and that is with a big jump in your marketing spend recently. How much do you think this might drop over the longer term?
We have a long-term ambition to keep bringing that cost per invested customer down. And the ways to think about that is to think about the drivers of that cost per invested customer and what are the drivers that determine the level of the cost per invested customer. The first one is, of course, brand awareness. And that is an area where we have been making many investments over the past decade. Our brand awareness now stands at around 25%, meaning that we are achieving the critical levels to drive down the cost per invested customer. And the way that works is if you see us online or if you see us digitally, if you recognize us through our brand, you are much more likely to click, meaning that that will drive down our cost per invested customer. So brand awareness is going up, and that will help us drive it down. The second aspect is around the velocity of the marketing expenditure. And we have now reached a point where, as you can see from the guidance, we're looking at a marketing budget of around 17 to 20 million for the year. And that is a fairly sizable marketing investment. It's a fairly big marketing budget. And therefore, you can expect that the velocity in the increase and the absolute increases against that type of budget are likely to be smaller than perhaps they were in the past when we were starting with a budget of 2 million or 4 million. And so as the velocity and as the absolute growth in the marketing budget reduces, you can expect the cost per invested customer to continue coming down because spend rates are declining as we had always planned for them to do. And then the third aspect is our data and the wealth of data that we have that informs the way that we deploy that marketing budget. That data continues to get stronger and deeper across many more channels, and combined with the other two factors gives us a lot of precision and a lot of information around the best way to deploy the marketing budget. So you can expect to see ongoing and continued declines of that cost per invested customer that we expect to deliver over the coming years.
Thank you. Are you seeing any trends of clients shifting money between plans with recent market falls, i.e. perhaps from higher to lower risk?
Good question. We follow the FCA's guidance in this respect and don't actively promote customers to lock in their losses when markets are down. We have a view that markets will continue to go up in the future and over the long term, and all of our plans are designed to deliver long-term returns. We do have a very low risk plan known as the Preserve plan, which essentially invests in money market instruments. However, we haven't seen a notable change into that plan because we are of the view that pensions are long-term investments and our customers should continue to invest for the long term so that they can benefit from the compounding returns that investing brings.
Okay, thanks. And then perhaps last one here on inflation, unsurprisingly, and how does the recent spike impact on your cost base? Are you seeing a slowdown in customer contributions, perhaps because people want accessible cash?
Yeah, perhaps we can start with the customer contribution side. I think, Christoph, if you'd like to make a few comments, and I can also help on the cost base.
Yeah, I'm very happy to. So in terms of inflation and impact on the business, as you pointed out, let's start maybe with net flows. And I think the way of how you think about our net inflows is that there are two components. One is consolidation, further consolidation, which are basically existing pots somewhere else that the customers bring, so to speak, to PensionBee. And then the second one is contributions. As you can imagine, consolidations is less impacted from that perspective, from an inflation perspective, because those pots exist already, and it's more a matter of bringing them to PensionBee. And then on the second point, which I think I can see where your comment is coming from higher inflation to potentially impact contribution. That was something we very closely monitored because of that reason. But what we actually saw in the data that this has been very consistent with what we have seen previously. So the impact on contributions per se, given the inflationary environment, is actually less visible in the data. And then on the second point around the cost base, I think where we probably see it marginally coming in is around the employee cost base in terms of new hires, as we are still investing in the product and the efficiency of the technology platform. And we see this marginally coming through with some of the tech hires and IT hires specifically. But I think our approach to that is to actually use a remote environment, and therefore can actually then also recruit across the country, which alleviates some of that inflationary pressure, which is particularly impacting London per se. Anything to add from your side, Romi?
No, I think you covered everything. I think the only thing that I would add is there are areas where inflation, we believe, has resulted in a pullback. And one of those areas is in marketing budgets. And so when there are pullbacks in marketing budgets, that actually creates opportunities for us. And so from that perspective, I think, I think that we've actually had the opportunity to benefit.
Thank you. A helpful summation, and we look forward to catching up with you again, probably around September time for your results.
Thank you very much, Hannah.